Greetings, financial aficionados. Today we delve into the exciting world of 4 attractive monthly dividend ETFs. Now, before we dive headfirst into the specifics, let's take a moment to understand the concept of monthly dividend ETFs. Exchange-traded funds, or ETFs as they are more commonly known, have revolutionized the way we invest. They offer an affordable, flexible, and diversified avenue for investors to gain exposure to a broad range of assets. But what if I told you there was a special breed of ETFs that not only provides this exposure, but also pays out dividends on a monthly basis? Yes, you heard right, monthly. These are monthly dividend ETFs, a unique type of investment vehicle that distributes income to its shareholders every month. This can be a game changer for investors who rely on regular income from their portfolio, such as retirees, or those seeking to supplement their regular income. Now that we've established what monthly dividend ETFs are, why are they important in the financial world? Well, they provide a steady income stream, which can act as a cushion in volatile markets. Moreover, the compounding effect of monthly dividends can significantly enhance returns over the long term. Today we'll be exploring 4 such attractive monthly dividend ETFs: SPHD, or the Invesco S&P 500 High Dividend Low Volatility ETF, QYLG, the Global X Nasdaq 100 Covered Call and Growth ETF, KNG, the Cboe Invest S&P 500 Dividend Aristocrats Target Income ETF, and last but not least, TFLO, the iShares Treasury Floating Rate Bond ETF. Each of these ETFs offers its unique blend of assets and strategy, and we will be delving into each one of them. So buckle up as we embark on this fascinating journey into the world of monthly dividend ETFs. Stay tuned as we delve deeper into these intriguing financial instruments. Hello viewers, if you are enjoying this content, and you do not want to miss future videos filled with even more tips, tricks, and inspiration, hit that subscribe button now to stay tuned with us, and remember to comment and share. First up on our list is SPHD, a unique blend of stability and income. This exchange-traded fund, or ETF for short, is the Invesco S&P 500 High Dividend Low Volatility ETF. As the name suggests, it seeks to provide investors with a steady stream of income through dividends, while also striving to maintain lower volatility compared to the broader market. So how does SPHD achieve this? Let's break it down. SPHD tracks the performance of the S&P 500 Low Volatility High Dividend Index, which is composed of 50 stocks from the S&P 500 Index. These aren't just any stocks, though. These are carefully selected based on 2 key criteria: high dividend yield and low volatility. By investing in these stable dividend-yielding companies, SPHD aims to provide investors with a regular income and less exposure to market swings. Now you might be wondering, why would anyone want to invest in a low volatility ETF? Well, the primary benefit of low volatility is that it can help to smooth out your investment returns. In other words, when the market is experiencing ups and downs, a low volatility ETF like SPHD could potentially offer a more stable, albeit slower path to growth. This can be particularly attractive to conservative investors who prefer to minimize risk. Besides offering a steady stream of income and lower volatility, SPHD also provides investors with broad exposure to various sectors of the U.S. economy. This makes it a well-diversified investment option, capable of weathering different market conditions. But, like all investments, SPHD isn't without its risks. One of these is the potential for underperformance in bull markets. This is because low volatility stocks are typically less responsive to market upswings. So during periods of rapid market growth, SPHD might not keep pace with other investments that are more aggressively positioned. Furthermore, while the focus on dividends can provide a consistent income stream, it's important to remember that dividends are never guaranteed. Companies can choose to reduce or eliminate their dividends at any time, which could impact the income generated by the ETF. So, who is SPHD best suited for? Well, it's an attractive option for conservative investors who prioritize income and stability. It can be a good fit for those who are close to retirement, or those who simply prefer a less volatile investment journey. It's also worth considering for income-focused investors who are looking to diversify their portfolio beyond traditional income-generating assets like bonds. To sum it up, SPHD offers a unique investment strategy that combines the pursuit of high dividends with a focus on low volatility. It provides a steady source of income, broad sector exposure, and the potential for less turbulent investment returns. But like any investment, it also carries risks, and it may not be the right fit for everyone. Before investing in SPHD or any ETF for that matter, It's important to do your own research and consider your individual investment goals, risk tolerance, and time horizon. You may also want to consult with a financial advisor to ensure that the investment aligns with your overall financial plan. In conclusion, if you're looking for an investment that offers a blend of income and stability, SPHD could be a compelling option to consider. It's a testament to the fact that investing doesn't always have to be a roller coaster ride. With the right strategy, it can be a steady journey towards your financial goals. SPHD, a fantastic blend of income and stability for your portfolio. Next, we explore QYLG, an ETF that combines growth and income strategies. Delve into the fascinating world of QYLG, short for Global X Nasdaq 100 Covered Call and Growth ETF. This unique financial instrument marries the robust growth potential of tech giants with a steady income stream from a covered call strategy. In the ever-evolving landscape of investment, QYLG stands out as an attractive option for those seeking a balanced approach to growth and income. Now let's unpack what QYLG is all about. At its core, QYLG is an exchange-traded fund, or ETF, that offers exposure to the Nasdaq 100 index. This index is home to the 100 largest and most active non-financial domestic and international companies listed on the Nasdaq stock market, many of which are tech heavyweights like Apple, Amazon, and Microsoft. This means that when you invest in QYLG, you're essentially buying a piece of these tech giants, thereby capitalizing on their growth potential. But QYLG isn't just about growth. It also employs a covered call strategy, which is an option strategy where an investor holds a long position in an asset and writes or sells call options on that same asset. In simpler terms, it's a way for investors to generate income from the assets they own, above and beyond any growth those assets might experience. The income comes from the premiums that investors receive when they sell the call options. This strategy is particularly useful in flat or slightly declining markets, where it can provide a buffer against potential losses. The benefits of QYLG are twofold. Firstly, it provides exposure to some of the most dynamic companies in the world, which can lead to robust growth. Secondly, it offers an additional income stream from the covered call strategy, which can be particularly beneficial in times of market uncertainty. But as with any investment, QYLG is not without its risks. One of these is the potential for underperformance in strongly rising markets. This is because the covered call strategy limits the upside potential of the underlying assets. When markets are soaring, the income from the call options might not make up for the lost growth potential. However, it's important to note that this risk is counterbalanced by the income buffer provided by the covered call strategy in flat or declining markets. Another risk is the heavy exposure to the tech sector. While this can lead to significant growth, it also exposes investors to the volatility inherent in this sector. That said, the tech sector has shown remarkable resilience and growth potential over the years, making this a risk that many investors are willing to take. In conclusion, QYLG offers a compelling blend of growth and income. It allows investors to benefit from the dynamism of the tech sector, while also providing a steady income stream through a covered call strategy. It's an investment that requires careful consideration and understanding of the associated risks, but for those who are willing to navigate these complexities, it presents an attractive option in the quest for growth and income. QYLG, a unique mix of tech exposure and income generation for your portfolio. Now we examine KNG, an ETF that targets the cream of the crop in dividend payers. The Cboe Vest S&P 500 Dividend Aristocrats Target Income ETF, or KNG for short, is an exciting option for investors who are looking for consistent income. KNG employs a unique strategy that is designed to provide exposure to the S&P 500 Dividend Aristocrats, a group of companies that have not only paid, but also increased their dividends for a minimum of 25 consecutive years. Talk about reliability. What sets KNG apart is its strategy of buying and holding these dividend aristocrats while also selling covered call options. This approach, known as a buy-right strategy, is designed to generate additional income from the option premiums. It's a bit like having your cake and eating it too. You get the potential for capital appreciation from holding high-quality dividend stocks, plus additional income from the option premiums. But let's dig a little deeper into the benefits of KNG. Firstly, it provides exposure to the top dividend payers in the market. These are companies that have proven their ability to generate consistent income for shareholders, regardless of market conditions. This consistency can be a great source of peace of mind for income-focused investors. Secondly, KNG's strategy has the potential to provide an attractive income stream. The ETF targets an annualized income distribution of 3.5% over the annual dividend yield of the S&P 500 index. That's not too shabby, especially in an environment where interest rates are near historic lows. However, as with any investment, KNG does come with its share of risks. One such risk is the potential for underperformance in growth-focused markets. Since KNG's strategy involves selling call options, the ETF could miss out on some upside potential if the underlying stocks appreciate significantly. It's the classic trade-off between income and growth. Another risk is the reliance on Dividend Aristocrats. While these companies have a long track record of paying dividends, there's no guarantee that they will continue to do so in the future. Changes in a company's financial health, business conditions, or even tax laws could impact its ability to pay dividends. So, why might KNG be an attractive option for income-focused investors? Well, in a world where reliable income is hard to come by, KNG offers a degree of consistency that is hard to beat. Its strategy is designed to generate income from two sources, dividends and option premiums, which could provide a buffer against market volatility. Moreover, KNG also offers the potential for capital appreciation, thanks to its exposure to the Dividend Aristocrats. These are companies with a history of not just paying dividends but growing them over time. This could lead to an increase in the value of the ETF's holdings, providing a nice little bonus on top of the income. In summary, KNG is a unique ETF that targets consistent income from the market's top dividend payers. Its strategy of buying Dividend Aristocrats and selling covered call options provides exposure to a group of high-quality companies, while potentially generating an attractive income stream. However, as with any investment, it's important to consider the risks and your individual circumstances before diving in. KNG, targeting consistent income from the market's top dividend payers. Finally, we take a look at TFLO, an ETF that offers a unique take on income generation. Dive right into the world of exchange-traded funds with TFLO, otherwise known as the iShares Treasury Floating Rate Bond ETF. This intriguing financial instrument employs a strategy that sets it apart in the ETF marketplace. TFLO primarily invests in U.S. Treasury floating rate bonds. These are unique in that their interest payments adjust or float in response to changes in discount rates of 13-week Treasury bills. This floating rate mechanism makes TFLO an interesting player in the ETF space. It provides a level of protection against rising interest rates that is often missing from fixed-rate bond investments. In a world where interest rates can change at the drop of a dime, having an investment that can adapt, like a chameleon to its environment, can be a powerful tool in your financial arsenal. But what makes TFLO truly shine are its benefits. First and foremost, it offers a lower interest rate risk compared to traditional fixed-rate bonds. This is due to the floating nature of the bonds it invests in. If interest rates rise, the interest payments on these bonds increase as well, helping to maintain the bond's value. Secondly, TFLO provides a regular income stream. The ETF pays out monthly dividends to its holders, providing a steady flow of income. This can be particularly attractive to more conservative investors looking for a predictable return on their investment. However, as with any investment, TFLO is not without its risks. One of the most notable is the potential for low yields in a low interest rate environment. Since the interest payments on the bonds it holds are tied to the discount rates of 13-week Treasury bills, if these rates are low, the yield on the ETF could also be low. But it's important to remember that all investments come with a degree of risk, and understanding these risks is a crucial part of making informed investment decisions. Despite these risks, TFLO remains an attractive option for many investors. Its unique strategy, coupled with its benefits of low interest rate risk and regular income, make it a compelling choice, particularly for those with a more conservative investment outlook. But perhaps the most appealing aspect of TFLO is its potential to act as a stabilizing force within an investment portfolio. In the turbulent sea of the financial markets, having an investment that can weather the storm of rising interest rates can provide a sense of security. It's like having an anchor holding steady amidst the ebb and flow of the financial tides. And in a world where certainty can often seem in short supply, having a reliable source of income can be a comfort. In conclusion, while TFLO may not be the flashiest ETF on the market, Its unique strategy and potential benefits make it a noteworthy option for investors seeking a steady income stream with lower interest rate risk. Remember, investing is not just about chasing the highest returns, but also about finding the right balance for your individual financial goals and risk tolerance. And for those seeking a steady hand in uncertain times, TFLO might just be the safe haven you're looking for. TFLO, a safe haven for regular income in your portfolio. There you have it. 4 attractive monthly dividend ETFs that could enhance your investment portfolio. Let's take a moment to recap what we've covered today. First, we examined the Invesco S&P 500 High Dividend Low Volatility ETF, or SPHD. This fund's unique focus on high dividend, low volatility stocks makes it a compelling choice for investors seeking steady income with a side of capital preservation. Next, we dove into the Global X Nasdaq 100 Covered Call and Growth ETF, known as QYLG. This fund's covered call strategy offers the potential for high income and capital appreciation, making it a solid pick for growth-oriented investors who also appreciate a monthly income stream. Our third stop was the Cboe Vest S&P 500 Dividend Aristocrats Target Income ETF, or KNG. This fund's commitment to stocks with a long history of increasing dividends can be a boon for investors looking for reliable income growth over time. And finally, we explored the iShares Treasury Floating Rate Bond ETF, abbreviated as TFLO. This fund's focus on U.S. Treasury floating rate bonds provides a hedge against rising interest rates, making it a smart choice for those looking to protect their portfolios from inflation. Each of these funds offers unique benefits that can cater to different investment styles and goals. Whether you're a growth-focused investor, an income seeker, or someone looking for a hedge against inflation, there's an ETF here that could be a great fit for your portfolio. Remember, investing is not a one-size-fits-all endeavor. It's about finding the strategies and assets that align with your specific financial objectives. And with these 4 ETFs, you have a diverse range of options to consider. If you found this video helpful, please do subscribe, like, and share it with your fellow investors. Until next time, keep investing wisely. Sting.